Hey, welcome to the podcast, everybody. Thanks for joining me. Appreciate it. Well, the stock market is now closed, and as you can see from the screen, bright. I guess the brightest green that you could possibly have. Dow Jones up to 13,291, up 243 points, almost 2%, closing at the high of the day. Everything across the board was up. You can see, obviously, risk on, NASDAQ tech stocks, semiconductors very strong, small and mid caps participating, even utilities participating, some of the consumer staples joining in, and the transports, which were lagging this morning. They were basically behind the averages about 1%. At one point, they were only up 1%, market was up 2%, and they closed the gap. And so you can see the Dow Jones transports finished up back over 5,000 to 5,044, up almost 2%. Really, the only thing you could say about that was negative today was if you were an oil bull, you had the run, and then it pulled back as the day went on. But all in all, a great day for the bulls. All right, so we know the market went up today based on Mario Draghi's comments, and we got a little bit better than expected economic data with employment possibly giving a little leak as far as what the number may look like tomorrow, which is the official government numbers. Today was the ADP number, and the initial jobless claims came in a little better than expected. So once again, we've been talking about the fact that maybe the biggest risk to the bulls was the fact that they were banking on some type of further quantitative easing, either by the U.S. or by Europe, and that maybe they wouldn't get it because the economy was perhaps a little better than people expected. It wasn't great, but it wasn't awful. So could that be the case? Well, what we saw today was confirmation of that in some regard because we saw the data come out a little better than expected. So you would think, well, maybe the market sells off because of the fact that it lowers the likelihood of the Fed coming in doing anything. However, let's look at it from the other side. Maybe the market is celebrating the fact that they know they're going to get quantitative easing. They know they're going to get this bond buying out of Europe. And on top of that, the economy is doing better. So maybe they're getting everything they possibly want. Maybe, maybe not. It's hard to interpret why the market goes up on any given day. And certainly, we've been seeing days where the market is down and you scratch your head and say, this doesn't make any sense. On the other hand, there's days where it goes up and everything seems logical. And then there's days it goes up and it doesn't seem logical. So it's all over the map. But the bottom line is we had kind of been in this trading range here where it was in this zigzag pattern. We got to this double, triple top, you might call it. It was a fake out breakout. And then we started trading this very narrow range. Now, if you're looking at this picture here of the spiders, which is the S&P 500 ETF surrogate, you will notice that the big bar from today isn't on there. I've backed it up one day to show you what we look like as of yesterday. Now, the bulls could argue, hey, well, it's just bouncing off where it should have. It came right down to the spot and it bounced perfectly. But I want you to notice something. If you take a look here, I've got in gray these Bollinger Bands, which are two standard deviations away from the price. And so as there's more volatility, the bands widen out. As there's less volatility, it tightens up. Usually after you get some type of tightening like we're seeing here, you don't tend to see that last very long. So I was expecting a move one way or the other, especially coming into the election here. And we've got the Democratic National Convention going on. We had the Republican one last week. So coming into the election, we expect volatility to pick up. And especially with these bands so tight, it seemed like it was going to break one way or the other. And of course, we add today on there, and you can see that broke above the old high. A little heavier volume. Obviously, the volume's still very low in comparison based on this 20-day moving average, but it did substantially break above and give the bulls something to cheer about. Now that the S&P is breaking out of this double top here and appears to be moving higher, at least for today, obviously the next question is where does it go from here? And if you're looking at this from a weekly perspective, 1575 is the old high on the S&P. That's about 150 points away, or about 10%. And there's one thing to keep in mind here. If, and this is a big if, but if this is a bull market that's transitioning into a bear market, which we've talked about being a high possibility, and that was this whole time frame in 2007 into 8. It was that time frame where it was gyrating around, making new highs, going down, big volatility. And then finally it cracked and it started making lower highs, and that was the end of the run. Now, at that time, there was a lot of moving averages that could have gotten you out at a reasonable time. You know, there was some warning in advance. Nobody knew that this big downdraft would come that quickly, that violently, but it did. But if we're in this transition phase, we still, and this is very important you understand this from a timing perspective, we still could get an S&P up in the 1500s. Now, is that to say that I'm banking on that? No, I'm not. But I do understand the fact that this transition period of bull market to bear market does take time and is something that can is a process over a long time frame. And because of that, you have to really trade based on timing. And people say you can't time the market. And I hear all that. I've heard every negative and positive about buying and holding and all those different things. The bottom line is this: regardless of your opinion on the stock market and whether it should or should not be going up, the fact is that it is going up right now. So if you're somebody that's sitting completely out or somebody that is short the market, just as we talked about, a few weeks ago, it's not very, very fun for you right now. So the thing that you have to do is say, okay, well, if I'm going to participate, because obviously not participating is not the answer right now, how do I participate and still sleep at night? And I think there's a few simple things that you do. And if you do these, it's not to say that you will outperform the market, but it is to say that you will make some money and still be cautious. I talk to a lot of people every day, every week, and have a very good sense on the pulse of investors. Now, you may talk to a lot of people yourself, but I talk to probably more than most of you on a daily basis. And when I talk to people, I haven't found one that is very bullish on this market. And I say that from a contrarian standpoint, right? Because if nobody's bullish, obviously what happens is days like this where you get some little bit of good news out of the economy, or a Fed president or the ECB president says something that people want to hear, and they're short covering, and it's just this exaggerated move to the upside. So it is a contrarian indicator that nobody seems to like this rally. But as we've said before, we're in an election year. There's stimulus across the board, and I think people are scared that they may get left out if ECB's easing, the Fed's easing, and let's not forget China, right? These coordinated efforts are a very powerful thing. And if that continues, the markets tend to go up, especially in an election year. But that doesn't mean necessarily that this thing is not going to roll over at some point. That's why time frames come into play. So if this is a process, then you simply say, okay, I'm going to invest, but I'm going to treat it like surfing. And when things start to slow down and the momentum slows, or I see risks, I'm going to get out of the way. That could involve stop losses or whatever. So I think there's a few ways to play this. Number one, as I've been saying for months, if not years, a lot of income. That's just a staple that you have to have in a portfolio in the year 2012. With interest rates very low or basically non-existent, you have to go find alternative streams of income. Not necessarily that you take it every month, but it's income that you will use for total return purposes. So that's number one. How do you do that? There's specific types of bonds. When I say bonds, don't go, what are you talking about? Interest rates are low, they're going up, bonds are getting crushed. I'm not talking about big, huge, broad baskets of tons of bonds and treasuries and all that. I am specifically talking about individual corporate bonds that are still very attractive. Those are still there. Are they attractive as they were 2-3 years ago? No, they're not. No, they're not. But they still should be a part of a portfolio. Then you start talking about business development companies, REITs, preferred stocks. There's all types of ways to invest in income production. Okay, so that's one piece of the puzzle. The second part of the puzzle is trades. I think when things get exaggerated one way or the other. For example, if you think things are stretched to the upside right now, then you would say, well, I'm going to look to short. I'm not looking to short the whole portfolio, but I'm looking to take the other side of the trade. That's a trade. I'm not doing that as of yet, but I'm just telling you when things get too stretched, you do that. It could be too stretched to the downside as well. Could have been last summer or maybe in June of this year, whatever. When things get too pessimistic too quickly. So that's one other way to do it, is to trade. Then there are individual companies. There's plenty of companies out there right now that have excellent fundamentals regardless of what the Fed isn't doing or is doing, regardless of who the president is or is not. and regardless of really where interest rates are and what's going on, geopolitically. I think those types of companies, while they may not be a quote-unquote buy and hold because of this type of market we're in, they are companies you can have a little looser leash with because the fundamentals continue to improve, and eventually the stock reflects that. I'll give you an extreme example, or it's not even an extreme, it's just kind of a duh one, is Microsoft. Up about 3% today. That's one that fundamentally is just cheap. It's not the greatest company ever. It's got all kinds of issues, but it's just cheap, and I have bought it and sold it in the past many times based on the fact that it ebbs and flows based on cheap or expensive. And it's on the cheap side, getting more expensive, but it's still a compelling deal. Now, there's other companies, and I don't want to mention a bunch because of the fact that for multiple reasons, but some of these are small and mid-cap companies that are doing very simple things that you can easily calculate what the return should be. You can see what the risk is on them. You can see what their business is, what their competition is, how do they compare. Really do your homework. Those companies are out there, and that should be a part of the portfolio. Then you start moving into things like things that aren't contingent on a strong economy for them to perform, whether that's utilities, whether that is telecom stocks, whatever it is. Now you may be saying, hey, well those are staples, right? And they've been underperforming lately. They have, and it's because they had such a huge run. People took profits. I think utilities look great right now. As we take a look here, I'll bring it up on a daily picture, and you can see they had sold off quite a bit. This is XLU, and they've bounced nicely right on this old breakout level. So that's a nice move there. And again, a 3.8% yield, and you get a basket of utilities, something that doesn't require the economy to rip roaring to do well. Okay, but what's happening right now is there's an adjustment going on because people are saying, well, maybe we're too bearish, right? Maybe we're believing the ECRI call that a recession was imminent, and maybe it's not. That's okay because that repricing could happen, and it is happening. But to the extent that the economy is going to be great going forward, and that you should be selling all interest rate sensitive things and buying the most cyclical things in the world, that may be a trade, but that is not an investment for me right now because I do not see the economy re-accelerating. Again, as I said, at best, it's economy that is stagnant and at least is not in a recession. And that may be enough to keep our stock market going up, but it's certainly not one to make me completely change my overall investment thesis. But there are trades to be made. If there's times where, for example, you want to go buy coal stocks, which are severely beaten up. This is a basket of coal stocks, and you can see up until today, they were making new lows again, even as of yesterday. If you want to take a shot at those as a trade, fine, but are you going to make an investment in coal or very cyclical things that make a lot of money when China's doing well and Brazil and India, when those economies are decelerating? I'm not willing to do that right now. But I think staying engaged in the game is fine right now because, again, it is about time frames, and while this market may still look very lethargic, and I'm still seeing deterioration, despite a 250-point gain today on the Dow, there is still deterioration in the big picture going on where less and less stocks are participating. We know that the volume's been horrible. If we look at the S&P, this blue line is the 20-day average. It's continuing to come down. The volume on the markets has been non-existent. Nobody wants to make a move one way or the other, okay? But they look at the American stock market and say, well, it's the default. It's the best house in a bad neighborhood. And there are some good companies, certainly. But when you look at this, I think what's happening is when you start going, well, China's slowing down, Europe's slowing down, bonds are expensive, treasury bonds are extremely expensive, cash doesn't yield anything, where do I go? American stocks still seem to be the place to be. Do not rest, though, and assume that everything is just okay because of a one good day. But we do acknowledge this breakout up here and say, okay, what do we own? What do we want to own? And I think getting more invested at certain times is fine, but I wouldn't be shifting the risk profile of your whole portfolio to look like, more cyclical type things right now. Again, individual stocks may be fine that you have specific sell disciplines on, but to go buy a big basket of industrials or a big basket of steel or coal stocks, again, outside of a trade, doesn't make a lot of sense to me. So that would be the way I'm playing it. And again, I hope the economy does start to reaccelerate and that those types of things do make sense to buy. But right now, I think what's happening is today it was about, hey, we got better economic data and they're gonna do more easing. Boy, free money. That's what the market was celebrating today, I suppose. And so it jumped out of the gate and it got stronger as the day went on. But almost everything participated today. So you did see the things like utilities even participate in some of the staples, which they hadn't been lately. So there's not a bunch to say about this rally today, at least, except that obviously it broke above this with conviction, didn't reverse like it did on the previous fake out breakout. So, but again, given that, if you say, well, hey, I got the all green sign now because it broke out, just be careful a little bit and realize that you need to still have sell disciplines on pretty much everything in the portfolio because this market can always change on a dime, especially with we've got a jobs report in the morning, the official, unofficial jobs report, the tweaked government numbers jobs report coming out in the morning, and again we've got an important election coming up. But look, the bottom line is, right now the stock market really isn't moving on the election at all, as far as I'm concerned. It's still addicted to some of this stimulus, and it's been getting it in the form of jawboning and these new plans coming out. And as long as it gets that, it seems to want to go higher. And regardless of what your technical indicators are doing, price action is still the most important dynamic here. Right? We can have negative divergences and we can have moving averages and all these things. We can have low volume, right? But at the end of the day, it's about the price. It's about buying low and selling high. And right now, again, if people are short or have all cash and saying, I'm just not going to participate, you're missing out because there are some good gains to be had. And today, obviously, we saw an example of that. CarlEggers.com, EggersCapital.com. There's a subscription there on these pages. There's Facebook, there's Twitter, there's Google Plus. We're on all of those, so look us up. And if you're not subscribed, go ahead and do that. Just punch in the email on CarlEggers.com, and we'll send you the podcasts and any articles we write will come over the email straight to your inbox. Thanks a lot. Have a wonderful evening.